In this video, guys, we're going to look at finding the next short squeeze. Stay tuned. Hey traders, warm welcome to you. All right, so let's quickly identify what is a short squeeze. So a short squeeze is when traders are short. There's a lot of traders, hedge funds, institutions, whatever it may be, who are short a specific company. In other words, they are betting on the company going lower. Maybe they're betting on it going bust. Maybe they're betting on it just going lower and it's overvalued. There's two types of shorts there. You've got the short that's really high and they think, okay, it's going to come back. It's worth about half what it is or a tenth of what it is. And the other short is it's already really low and they're just squeezing it down. You don't use squeeze again, but they kind of think that the market's going to go low. I think it's going to go bankrupt and they're kind of squeezing it to zero effectively. Now, what does this mean for traders and what is a short squeeze? A short squeeze is when these shorts are wrong and the market is going higher and higher and higher and higher and they are hurting because they are losing lots of money. And as we know with shorts, your losses are unlimited. If the market goes up from $1 to $100, ouch, if you're short, that's a huge magnitude order of loss. If you're long, great. So short squeezes mean that they just can't take any more pain and they have to kind of close the position. And the idea is that the more shorts start to cover, the more that causes price to go higher because they cover, of course, they're buying when they're covering. That causes price to go higher, more buying, more people are buying as well, and the shorts are covering, and we try and get this kind of cascade effect, or there's this cascade effect which causes prices to rip up to the stratosphere. Now, these can happen over a period of a few days, and you can kind of see them as big price spikes that kind of fall back. They can happen over a period of months and even years. A classic one from over the longer term right at the moment would be Tesla. Tesla, super highly shorted stock very early on and just kept going up and up and up and up and up and up. Now, there are still some shorts in it that might pay off for them, but the early short squeeze really caught them out. The double, triple, quadrupling in valuation just meant that those short traders on the short side couldn't stomach it anymore. Now, we've recently had these big short squeezes from companies like GMA, GameStop Corporation. We've started to see a little one from DDD, the 3D printing companies. Regardless of that, these are happening all the time, guys. And what we want to do as traders is try to identify where the next one might occur. And maybe we can buy a basket of these. We can look for them to start to go and jump on the momentum. If you're an intraday trader, you can play the momentum. On the flip side, you can wait for the squeeze to be over and kind of trade the kind of downside of the move, the back end of the move. A little bit more dangerous, but hey, these are just identifying volatile situations. Another thing I didn't mention, guys, is that if you're a short seller, you have to borrow those shares from someone. So generally speaking, me, Mark, individual trader goes, hey, I want to short this company. This is all done automatically, but I'll go to a fund or a pension fund or someone who's got these shares for the next 10 years and says, yeah, you know what, Mark, you can borrow those shares. There you go. Just give me 5% a year for that. And I'll go, fine. I pay them each day. Of course, this is done automatically in your broker. You just borrow the shares. This is what happens. And it's a way that the people who are the pension funds and hedge funds, institutions can maximize their returns. They're getting money from the short side. Now you might say, well, do they want to do that if it's going lower? They don't care. They don't care what happens in the short term. They're investing for the long term. But one thing they can do is they can recall their shares at any time. So they can say, hey, Mark, I want those shares back now. And the price might be up even higher. They might recall all their shares. And all of a sudden, there's a pressure on me to cover my short, not only from a financial perspective, because I'm under deep water, but also from a contractual perspective. And they're saying, hey, do you know what? I want to show shares back. So anyway, this is the short squeeze, and we get this kind of real rip up in price, very exaggerated kind of move that's just pushing on and on and on. So how do we identify them? So broad way to screen for these kind of things is to look for a short float above 20%. You can use FinViz, you can use any of these screening tools. Short float above 15 to 20%, something like that indicates that 20% of the shares in float are held short, and this is kind of a reporting thing that has to happen, especially in the US, so we know the approximate number of people who are short. You can look at days to cover as well, and days to cover is basically, okay, how many days would it take these shorts to cover, i.e. close a position under normal conditions based on the volume that's transacted. So that's another reference point as well. But short float is a good starting point. Then you kind of want to see the shares in float low as well. Not always, because something like Tesla and stuff was a real face ripper. We had Herbalife as well, this kind of thing. But if you look at these small cap stocks, or not small cap, but smaller stocks that really can get going, The number of shares in the float, less than 100 million, is a good indicator because that just reduces the amount of supply that's available, right? If there's a lot of people wanting to buy shares, you've got to find someone to sell those shares to, otherwise you've got to pay higher and higher price, and it causes a real rip in price compared to, say, you know, if you've got a billion shares in issue, because there's always going to be sellers available to sell those shares. It's going to be less exaggerated moves. So exaggerated moves come from the short float, as the short sellers, and the kind of inventory available to buy. Number 3, price at 52-week highs, or 4, price up 100+% over a month. So really this is, play with this one yourself. You want something that's already at highs and pressing to highs, that's moved a lot off a low, which is that 100% over a month, or 50% if you kind of want to drill it down a little bit, but something that's really kind of kicking into gear. 52-week highs, that's a good way. That's a kind of a broader short, but something that's moved aggressively. And play around, do the settings yourself to find some of these things, and then you use your eyeball, really what you want to do. And then you want several days of strong moves. So once these have come into your radar, this is normally what would kind of bring them into your screener, and then you want to watch them for several days of strong move. One day is not really good enough. You want to see that up, up, up. It's the start of a good short squeeze, and then you can start to time it and play the game of, okay, do I want to buy a pullback on this? Do I want to jump on momentum? Do I want to do this? You've identified the fact that there is actually people stuck short on it because it's got a high flow. You've identified the fact that there's not much inventory available to buy. You've identified the fact that it's come into your criteria from basically that it's just going up, because there's going to be lots of these that are about, they're just grinding lower and they're making the shorts money. These are the ones that are hurting them, so to speak. Prices 52-week highs, prices up 100% over a month, several days of strong move, and that's just a confirmation. When it comes into your watch list, you're watching up, 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 and then you're looking for some kind of entry on that, and that's kind of up to you as how you get in. Do you wait for a pullback? Do you look for a breakout trade? Personal preference, but just finding the next short squeeze a good place to start. Take care, guys. Keep your risk managed, especially on this type of trade, because they can reverse super sharply, can be up, 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 and then all of a sudden next few days are right back where you were. So watch out for your risk, be aware of the gap risk and all the other big boys and girls stuff. Take care, guys. Bye bye.